Welcome everybody. I'm just going to give you a quick run through of what I'm seeing in the markets, what I'm planning on and what I'm actually doing in terms of this high inflationary period that we've got. And I talked to you about how long I think this inflation is going to take to extinguish, and the impact on all of us, the impact on our daily lives, the impact on the next couple of years ahead of us, and how you can make inflation your friend, because you're going to have to do that if you do not get the right side of inflation, if you do not react to what's going on right now, then your pension, your savings, and even your daily income are just going to get weaker and weaker and weaker. All right, so any questions, punch them in the box. Bear with me 1 second, just got to do couple of things here. Right. Thing to note about inflation: how long can inflation last? A friend of mine went to presentation at the Bank of England last week and asked how long we can expect inflation to last. And the speaker said he thought inflation will be 4% next year. So we're going to peak back end of this year and come into 4% this year. I think that's absolute rubbish. Absolute rubbish. If you look at the inflation cycles that we've had before, so 79-80, we went right up to 18%. This crushed manufacturing in the UK, and even in the early 80s, we were still up here at 10, 12%, 8%, and we dropped and then ran up through the late 80s and early 90s, and we had a horrendous recession here as well. So this was a tremendous manufacturing recession. This was a recession here, and in the 07-08 crisis, inflation picked up as well as quantitative easing kicked in, and they started to print ridiculous volumes of cash. In my view, the central bank should have been raising rates at least 2 years ago, at least. As inflation was coming up here in this period, and of course in this subsequent post-pandemic period, we still got the pandemic. So expect inflation to be around for a long time to come, for a good long period. This is an incredible hike. We're in a commodity super cycle, so we'll talk about that aspect of it in a minute. But get used to high inflation. I think realistically, inflation is much higher than this rate anyway. So what does that mean? That means bonds are getting crushed. We've seen huge drop in the markets. The US markets are, or this NASDAQ is what, 45% down, and the S&Ps are over 20% down. This is confirmed bear market territory. So if you've got, we'll talk about what stocks you should be buying if you are in stocks, what you need to consider, and how to hedge and protect yourself, and protect your income from this. There are a lot of opportunities in this. In any kind of market, there is always stocks and commodities, etc. you should be buying. There are always ways of getting into the market, but the days of speculative growth stocks shooting up 100, 200, 300% are gone. for the foreseeable future. We are going to come out of this. When we do come out of this, as usual with any reversal, it's going to be, you should expect a good bull run, but we are long overdue this. So if you look at the monthly charts, whoops. Yeah, these monthly charts tell it all. We went on something phenomenal run, and we've clearly come out of that. There's more and more red on the chart, and the volume is increasing to the downside. The more we come down, the more the volume is increasing. So we are going to get pullbacks. In any bear market, we will get pullbacks. These pullbacks will potentially be quite swift, but once they find resistance levels, then the next leg will equally be swift. So you can get some short, sharp, short covering bounces, dead cat bounces in these markets. They are not to be invested in. I mean, forever since the back end of last year, particularly at the start of this year, I've been saying to everybody, I am very short-termism. I'm just swing trading. I'm not investing. So let's go back to a couple of other images I want to show you. So if you got high inflation and you achieve stagflation, what does that mean? That means economic growth slows, unemployment increases. So costs rise, and we're already seeing some issues to do with unemployment. So this is a chart of, this is equity clock, showing you the average price index over 2020 and 2021. So you've got the average here, tailing off as we come into the back end of the year, leveling off into the end of the calendar year. But this is where we were in 2022. So we were already powering up here. What were the Fed doing? The Fed were putting off rate rises and allowing this to go to these kinds of levels. And here we are just absolutely shooting up. This stops at May, so we've got this month's to kick in as well. So we are going to break these levels here and shoot higher. This is a typical stock cycle. Early recession, you've still got financials and stable stocks like utilities that are viable. And even real estate. Once you get, the property market is way too hot. Property market's got to come off at some stage. So that is something that in the 07-08 crisis, one of the best things to buy was actually land. Farmland was very cheap at that particular stage, and so investments in real hard assets, not the likes of Bitcoin and so-called growth stocks. They are, there's been so many margin calls in the market on what was a very, very high overinflated so-called disruption stocks. They come down to, they've gone right back to where they broke up from. So all the consumer staples and industrials, commercial services, that's great on a recovery cycle. That is not where you want to be when you are here. and you know, coming into a recession here. Technology, as we come through this, anything to do with some new strands of biotechnology coming out, NGA, talk about that in a minute as well. Technology, anything to do with automation, artificial intelligence, anything to do with economies and increased production, then that is the kind of thing we need to look for once we are in the recession and coming out of it. I think we're going to go into recession probably next year. I suspect we're going to avoid it this year. The only thing that might tip us back up again is if the Fed pulled back on expected rate rises. If we see, if the 3/4 point rate rise that we're expecting next month, we start next month on Friday, if we get a 3/4 rate rise again next month, then I think the markets will not be able to cope with that, and certainly in the early stages of that coming into the system, that will disrupt typically the the high streets and retail and so on. Property markets in the US and the UK are incredibly hot. We're real bubble territory in markets like real estate, so be very careful of that. Things you can do, ordinarily in this sort of market, you should be buying, well, I would be buying precious metals. Precious metals have seriously underperformed. So we need to keep an eye on that. If that changes, then I am invested in miners. So one aspect of this is you can invest in miners. I have US and UK miners, not to any great extent at the moment, but I will increase my position in the stocks if that pushes up. Bear with me 1 second. So if you've got financial advisors saying to you, just sit this out, it always comes back. If you're reading articles or watching YouTube videos saying, yeah, this is a great opportunity, this is a pullback in a trend, then be warned. Inflation is going to, this kind of persistent high dominant inflation is not going away. Putin's not going to back down. Russia is 40% of oil production and is the biggest exporter of gas. So these elements are going to come back to affect everything we do for the foreseeable future. If we are 18 months, 2 years off a recession, that's another 18 months, 2 years on top of that before we can come through that. So you're looking at a potential 4 to 5 years before it's worth actually sitting in stocks and investing in stocks rather than swing trading. And at the moment, we've also got the Chinese COVID zero policy as well. And of course, we've got the added issue of climate change. At the moment, Tokyo is in a horrible heat wave. It's very, very uncomfortable and difficult to work in Tokyo at the moment. They're even requesting housing owners to cut down the use of lights they use. So let's talk about what you can do to affect this. I think there will come a time when you can get back in this market, but let's look at these. Now, I was talking about gas, 2 years ago. 2 years ago, there are videos on YouTube that I've made public 2 years ago saying buy gas. This is how I structured this gas chart all this time ago. I was looking at this big box and looking at all the support down here, and look at the volume that came in October 2020. I suggested you started buying in March, April, May 2020, and we've had a good two waves up here, and pullbacks are still to be bought. So one thing you could do is buy commodities. You've got to time. It's about timing, as with any investment, it's about timing. So if we come down to let's stay with this for a minute. Now, with any box play like this, at the moment we've come back to the top of the box up here at 60 bucks, and that has recently got bought with $65 at the moment. Any market that tips back into the middle of this box, which is around about the 40 mark, if we see that price, that is potentially the next level to next pullback area. If we continue to pull back in a normal cycle in gas, the market would peak in the first week of November when all the main utility contracts are signed, and then it would fall off into the spring, the early summer, and then as you come into June, July, the contracts will get bought. If you look at this period here, let me get the pen actually. So here we had a push higher into November, falls back into the spring. Same happened here. We ran right up into November, pulled back into the spring, into the back end of the year, and then we have finally got some weakness very, very late in the season, but we've got the pullback is just a fraction of what you would normally expect. Normally you would see gas really come off and then before it piled up again, but these pullbacks are much more shallow, so it could be that this 60 bucks is about all we're going to get. So the next stop is going to be up here at 100, and then we could ultimately get into those highs. So we've had a 1, 2, 3 wave up here. We're currently pulling back. So we get a 1, 2, 3 wave correction into that support 40, then that is something to do. Now, one of my main favorite ways of getting involved and hedging inflation is what was called softs, the grains. I have actually bought this pullback in the wheat and looking to see if we can get back to 13 bucks plus. Ultimately, I think this move here from 750 to 13, I think that move can be repeated. And if I'm right, these pullbacks here could take us to 20 bucks. All right, so that's, you could, I'm not suggesting for 1 minute you sit in the futures market. There are good ETFs, Wisdom Tree, iShare, all these kinds of things. Beans have been on a run for beans have been on a move from 850 up to 17. Typically they would pull back this time of year. So if we do pull back into that trend line, if the wheat doesn't hold here and it continues lower, I will buy additional levels on any significant pullback. So 12 bucks, yeah, it's possible that we could see 12 bucks as we get towards the end of the year in grains. If you look at, if we switch to copper, copper is, I think that I believe the housing market is a bubble that it is in the process of, that will get burst. If that's the case, then something like copper is heavily reliant on the housing market. So it's not metals like, it's not markets like high grade copper I'm interested in. It's the softs and the precious metals. Talking of which, gold. Is still struggling, and you can see ever since I remember I was in a seminar, a webinar here in summer, August 2020, and a particular famous investor said gold will break 2000, pull back to 1900, 1950, and then go to 2023, 2,300, 2,500. Whilst I'm bullish the gold, I think we're getting close to a reversal. But my aim would be, I think 2,300, 2.5 is easy reach. I don't think this is going to scream higher. I don't think this is really going to run to the extent of an extension. I think it's going to be the commodities and the usable commodities and energy that are going to be the ones that are going to extend, not hedging materials, precious metals like the gold. The silver could be different because it has an industrial use, whereas gold has very little use. You see the silver, all assets at the moment are getting sold because of the, to say all assets, many assets are getting sold because of the fear and the margin calls that are being triggered in the market. And I think the silver and the gold are prone to that, are exposed to that. So you can hear we're after this move into 40.75, that's pulled right back into 24.40. So this is coming right into a key support area. So silver I would include in my portfolio if we can get some commitment and some volume here on this pullback, and if that turns around. So as far as engaging this market, I'm looking to the commodities, and I'm looking to getting to these markets that are going to benefit from this environment we got. The obvious way of hedging as well is, just flick to this market. The obvious way for hedging is also to wait until we get a kickback. Wait till we get a bounce in this market, ready for this to get another leg down. So if this, again, you can do this without a lot of leverage. This is actually, yeah, this is fib to 2021. So this is 2021 highs and lows here in the S&P. So if we now get, if any return back to 4,400 is a potential place. So that would be March's resistance area and the drop zone from April. If we come up here and get a lower close in the weekly chart, then of course one thing you could do is buy some short ETFs and hedge and trade that to the downside in stocks in the indices like this. Oil is incredibly volatile. In case you hadn't noticed, there are ways of, if oil really drops to these lower levels, I would look for 95. We've got July 4th coming up. What normally happens is on July 1st, a lot of Americans jump in their cars, fill their cars up with all they need for barbecues and picnics, and then go on long drives, consuming vast amounts of fuel in gas-guzzling cars, and hence the reason why you tend to get oil that sits up this time of year. And then once this drive season comes off, you normally get oil dropping off. So this is a daily chart here. If this oil drops off and doesn't and starts closing lower here, I would look for 95, at which point you can I would start to buy funds and oil stocks to make use of a potential another leg up to 120 plus once the cycle comes back in oil. And the cycle normally comes back in January, February. So be careful if you're in any oil stocks at the moment. Be careful. Potentially take profits if this starts to show weakness, and then think about getting back into oil in that period. All right, so the other side of this is once the fear really kicks in, and once, talk about if you're in stocks at the moment anyway, if if we get some decent retracements in this market, and we are due a bounce, we've already had a push up from mid-June, met some resistance. If we fall back into this area here and hold, then I think we could, I'm hoping that we're going to wind up during the summer. And then once we get in towards September is traditionally very volatile anyway. We've got triple witching in September, which tends to exaggerate the volatility. So my best case scenario is that we would wind up, maybe fall back further, and then wind up into the summer. I really hope we do this. And then capture shorts, offer out on the short side, and then see if we can break these lows and come back down lower into the back end of the year, into early next year. The other side of this is, I mean, there are ways, if you're an active trader, then another way you could do is sell weak stocks in weak sectors. And I've been short Card Factory a couple of times. Talked about this a lot on our Wednesday evening sessions. Every time this touches 65, this thing falls out the sky. So I traded it here in January. I actually took it off on this trend line mid-January, got back in late February. Took it off once it started to hold this area down here, and I only just recently got back in end of last month at 65. I did a short piece on it with capital.com. I suggested that other traders might want to get in on this. They did a feature on it recently. Now this is already very low. Look at the volumes are petering out. So I hope that if we can come into this support area, I'd love to see this push back to 56 plus to give me a chance, because I actually took some profits at, well, I took this off at 47. So I got 65 to 47. I'm doing what I did in January, now hoping that we can get some kind of bounce into the autumn again. And I'd love to get to 65, 70 would be fantastic if I can get an opportunity to get short that. But so the retail sector is obviously very exposed. Consumers are pulling back. So obvious shorts are these stocks. What's another one? Shoe. I'll come on to yours in a minute, Jonathan. I've lost it. There it is. Oh, that's interesting. That's spiked right up, shoe zone. And it's spiked up into an area that really interests me. This is going to go back on my key watch list, because if let's go to a monthly chart. You can short these with very limited exposure. This is a good classic basic bear rating strategy. You pick the right sector for the right market, i.e. retail, target the bricks and mortar stocks, and then when they retrace back to these areas, start to short. I'm going to start to short this now if we see a lower daily chart. Notice how we've come up on lower volume. And so if we can fail here, you come down 3 times faster than you go up. So that's why I like these shorts. I've taken my eye off the ball on this one, but that's all right, because that's allowed this to wander back. Let's look at a weekly chart. Very nice. That's exactly what I want. Right, so if I fib this recent high, this is a sell, key sell area is up there. Last time we dropped, we sold from 183. So either we push into that area or I get short. Otherwise, if the daily chart shows weakness here, then I'll short the daily chart. In fact, let's look at the daily now. No, that's sitting right up. Okay, so let's look at Boo. Wow, it's horrible, isn't it? That's really horrible. Every time this pokes its head up, so we had a buy signal here on the June 17. Why was it a buy signal? We had a new low in the range and immediate close higher. But all we've done since is drift lower with some 1 or 2 higher closes. The main low down there is 52. Let's tidy this up. If this is going to have any potential upside, then it's got to start closing above this 50, 53 in the next couple of days, or at least the next week. Otherwise, this is lower. If we come down to 51 and break, there's nothing to say this can't just keep going lower. The volume on the downside is diminishing, but the volume to the upside is almost non-existent. So unless you start to see that rise on volume, that one looks lower. ASOS, very similar story. I think this was the earnings, 16th of June. That's come right into an extension and closed under an extension at 9.11. So unless that closes back above 10 in the next couple of days, that is cooked as well. If it can close above 10, it may over a period of time get back to 11, but it's going to need a lot of volume and yeah, a significant shove higher to get to push that back. You got some options. You could ramp the stop up underneath where we are right now and see if you get stopped out. If you we are at support on these stocks, but if they break this support and stay under this support, then it's cooked. So either take it off or just keep your stop very close to this action in an attempt to see if that can push back up. But even things like, what else have we got? But even things like Tesco. Okay, Tesco's recovering here on volume. And I guess Sainsbury's done the same. Tesco's is reacting much better. Royal Mail Group, wow, look at that. The brokers had a price tag of £6 on this not so long ago. It's just awful, isn't it? It picks up and then just sells off. And it picks up and then sells off. So that makes me very interested in Shoe Zone and any pullbacks in Card Factory. So you can be, it depends if you're an active trader or more longer term. If you are a longer term investor, then you need to wait for, in terms of acting on what I've been talking about, you need to wait until we get pullbacks in the markets to sell highs. Let's look at, now these are organizations I'm interested in buying. These are biotechs that are high up the ladder in new technology called NGS. Don't ask me what NGS is because I need to research it properly. But look at this buy signal here on the 23rd of June on volume. If this stock closes above this 1932, then I'm going to buy it. If you look at Roche, see that if the solid stocks in essential markets or markets that are good cash generators can work. If you look at oh, I just forgotten the one I was going to show you. I've just forgotten it. No, I'll have to come back to it. But these are all stocks in the NGS technology arena, and they are all threatening to pick up and have indeed. Look at that. Of course, the lifeblood of the markets is volume, and some of these stocks are getting very interesting volume levels. If you look at housing, Barrett's, yuck. Very pathetic volume down here. Persimmon, a good dividend payer. Okay, it's bounced on volume. But all it's doing is coming to a lot of resistance. Look at that horrible sell here on the 16th of June. Horrible. Taylor Woodrow, attempting to recover, but not doing very well. Guys, I was going to show you something I've completely forgotten. Right. So let's leave it there. And just check where the markets are. Okay, seem to pick up in the markets. So I'm going to come back to this time next week and do a fuller update on this with some more specific ideas. But you know, like I said, I'm looking for these markets to pick up in the coming weeks. But then as we head in towards, as we come out of the back end of summer and into the autumn, I'm looking for much more turbulence. The bottom line is I'm expecting a earnings recession as well. Not only, you know, the cost of living and inflation biting into this equation, I'm looking for an earnings recession as time ticks away and the weeks unfold. All right, any questions asked now? Otherwise, I will come back to this. Let's take a look on, yeah, so gold is, this is the gold daily chart. It's coming down on volume. It's just not doing it. If we break this support, then could come down to 1780. 1780 will put us back in the January level. At the moment, if I strip these away, you'll see how important that level is. So unless we see some buyers come in and we step up to that you need to step away from gold and leave it. Right, no questions coming in. Oh yes, there is, hang on. I think in terms of when is a good time to start a pension, ASAP if you haven't got one. There are, over the next 1 to 4 years, there's going to be some fantastic opportunities in the markets. So if you have not got a pension, doesn't matter what age you are, then yes, start one. And focus on areas that are going to be relevant to the cycle that we're in. If you are under 40, then I would suggest you wait until the tech growth market starts to pick up again, or be very, very selective in some of the healthcare markets and the biotech markets. That sort of more speculative side should always be a smaller part of your portfolio anyway. Otherwise, you need to look at all these aspects of hedging that I've talked about in terms of commodities, potentially land and real estate when we're further down the line. And then once we come out the other side of this, I would increase your exposure to growth technology stocks and energy stocks. Any other questions? Right, brilliant. Thanks for your time. I will come back to you about next week's edition, and I'll lay out some more specifics next week and pick up where I've left off from here. Have a good evening, have a good afternoon, depending on where you are in the world, and bye.